Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. I said last time and the time before that the monthly key reversal up for July had really started something. It created a bullish halfway hesitation during the latter part of July for targeting the 780 even area, which was achieved. Then during the first part of August, we had the setup for another bullish halfway hesitation, a smaller one with a target X in the 794 area. This was on the way to being achieved until it fell short mid-August. I suppose it was not really a surprise, as the top of the market was capped by the upper time, currently 794 even, of the March to July bullish shift pitchfork. This is a shallowly bullish pitchfork, but one should not underestimate its power. Thus, target X will be retired after today. Anyway, prices continued a stuttering move lower, most recently being held up by the middle time, currently 707, of the same pitchfork, in combination with the lower time, currently 708, of the more steeply angled bullish Andrews pitchfork for the same move. However, yesterday prices have punched down through this support, as well as the rising short medium moving average, currently at 703, and the flatlining medium moving average, currently 700 even. Prices are now challenging the important January high at 693, as well as the 50% Fibonacci line for 2021 at 689. So that this week prices have managed to demolish a significant number of the supports for the bullish incentive. We now have below, if we manage to get below the 2021 50% Fibonacci line, the 50% absolute Fibonacci line at 675 and the 50% Fibonacci line of the big old 2012 to 2015 move at 670, plus the slowly rising up the long moving average, currently 668. There is little in between the 2021 50% Fibonacci line and these supports, and then little in between these supports if they are challenged and broken until the lows of July. So should we get down? Well, the market certainly has the ammunition. If it does fail to halt its decline, then we would still have a lower, if very tempered, bullish incentive, as the lower time of the bullish shift pitchfork is down in the 621 level right now, and there's the rub. We could set up a possible very, very large double top, Adam and Adam type, with a great potential on the downside, and possibly not following through lower because the bullish shift pitchfork is still holding there. All this, of course, depends on the market dropping lower, so let's wait and see. Chicago corn. As I mentioned last time, the most important feature here was the move down below the long moving average, currently 548 even. This break below the long moving average hasn't happened since really November 2019. The question last time was, would the market exploit this move lower, and if it did, which pattern would it choose? Now, the first bit was easy, though it was done with some style last week with a weekly key reversal down. However, prices did hesitate around the key combination of the 61.8% Fibonacci line at 525, which is also the 2014 high. That lasted until the end of the extended weekend that we've just seen, with prices moving down well below them both on Tuesday. The next question was, which pattern or patterns were and are showing out there? Well, there are two, maybe three main patterns. A sideways triangle and two descending triangles. Now, the sideways triangle was formed on the top side by the two-pointed downtrend, currently 573, from the start of July, and broken, well broken indeed, August 2020 to date uptrend, currently at 559, and is partner the long moving average, and that's currently at 548. This had a potential target X in the 509 area, which was achieved this week. The next two descending triangles are related. The smaller one uses, once again, the July to date topside downtrend, and on the downside uses the flat base of the previously mentioned key combination of the 61.8% absolute Fibonacci line at 525 and the 2014 high at the same level. This now has an initial target below in the 475 even area, with a secondary target in the 425 area, right on the 50% absolute Fibonacci line. The second larger pattern uses the higher, if broken, early July downtrend on the downside, on the top side, currently at 573, and the same base of the 2014 high and the 50% absolute Fibonacci line. This will give an initial target in the 463 even area and a secondary target in the 401 area, which happens to coincide with the 50% absolute Fibonacci line as well. It is also off the bottom of my chart, my daily chart right now. So this is not a done deal, as well as we could still have a pullback. But the pressure in the ammunition is very much for the downside right now. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.